Hey guys, I'm so sorry. I totally messed up my video. I was on like the wrong video and then I made the video and then I lost the video. So I'm going to redo it. I apologize. Okay, so this video is going to be discussing the analysis for this week on NQ futures. And then I'm going to go through 6 pro tips that I have prepared for you guys. And pro tips are in relation to the Power of 3 model that we discuss on this channel. And then following that, I have an entry that I want to discuss, and I'm going to be starting a series of entry anomalies that happen because not every entry is going to be perfect. So I'm going to be discussing that. So anyway, with that, we'll just get right into it. So here we are. I'm going to move to the 4-hour. I like to start on the 4-hour, take a look at kind of where we are for the week. And this is the hourly here. This on the right hand side are my 4-hour candles, so we don't have to worry so much about those. Let me just get those into focus. There we go. Yeah. And second. Okay, so hopefully you guys can see those 4-hour candles there. So, okay, so as we can see on the 4-hour chart, that price reached on Friday quite a nice high. We reached up into this green area, which is a daily BISI. And we did not quite take out the high from Wednesday, January 7th, but we certainly came pretty close to it. And we had marked this area here as buy side, so we can see that price came above buy side, took out buy side, and then we ended the day with a little bit of a pullback. Okay, so let's go to the monthly. I'm going to go to the monthly here. And on the monthly, again, don't worry so much about these candles over here. You can grab them as a free indicator, which I use the 4-hour extensively. So here we can see that price has been moving up for months, and then in November we had a little bit of a pullback, and then in December the range of this candle was pretty small actually. So I found December quite difficult to trade. And then here we are in January, price pulled back initially to begin with, and we can see that price has been moving up steadily since. What's important to me is this wick of this candle. I've added my Fibonacci to it and I've created quadrants. I will be watching these quadrants and using them as stepping stones if price decides that indeed it's going to expand up into this area. Let's move down now to the weekly. Here we are on the weekly. And you can see that on my chart, I have these levels, and it's because I pay $20 a month. I get a bundle. My levels are on my charts at all times, and I really enjoy that because I spend less time adding these levels to my chart every night and every week. It just makes my work so much faster. And okay, so here we are on the weekly. And we can see that last week price had a nice move up. Now this area here is an area that I'm watching. This is this orange area here. We can see that we have 2 long wicks that move into this orange weekly wick area. And I will be watching to see how price navigates up through this area. As we know, wicks are essentially gaps. And so we can anticipate that there's liquidity up here in this area. So this will be interesting to watch on Monday. Monday is a no trade day for me because it's the day before CPI. We have previous month high just above these wicks. So again, we know there's liquidity in there. And then if we move above here, then we can look to the left and we see 2 more candles with long wicks, and these are the highs. I have kept on my chart the order block. This down close black candle here, this is an order block. Um, but primarily we are bullish this week, and so let's see uh, from this area here up into these all-time highs if we can get to. Next, let's move to the daily, get a little bit more detail. Here on the daily, we have here our SIBI candle from between candle 1, candle 2, and candle 3. We can see that price has moved up. Then we had this doji candle, price moved down, and then on Friday we moved back up through this area. I am keeping this level as a key level on my chart, and as well I am keeping the BISI from candle 1, 2, and 3 on my chart as well. I have sell side below that. I would be interested to see on Monday if we have a pullback. We could even pull back into this daily busy. Again, this is a strong area in anticipation of moving higher if price wants to expand higher, and using CPI on Tuesday as the impetus to moving higher. Now, I want to explain this SIBI up here. This area up here has been untouched since November 3rd. And so I have labeled this, potentially it could be a mitigation block, but price could, if price was very, very bullish, and we're just anticipating that price will be bullish, we could anticipate that price might get above this SIBI and then use it as support on the way to this area up here to all-time highs. One thing I do want to caution on is ICT has taught us that as price moves into areas of all-time highs, we can anticipate uh, volatility. You know, wicks moving up and down, potentially uh, price kind of consolidating. So be aware of that. Just be a little bit cautious. If price continues to move higher, that we may see some of that price distortion as we move up into this area, if indeed price moves up into this area. Basically, for my strategy for the week, I will be looking for a very nice pullback where price can access liquidity before moving higher. So I will be looking for buys, and I will be very interested to see if price could even move, you know, maybe even down below here to take out the sell side, although that's a long way down, but we will see. So let's move now to the 1 hour. On the 1 hour, we have our 4 hour area or level here that we've had on the chart for 6 weeks now, 4 to 6 weeks. And it was interesting to see on Friday that price came right down. It whipsawed down here. It took out all of this liquidity before moving higher. And it was a beautiful setup. In fact, we can even see from the 4 hour candle that price opened here. Wick came down. It took out all of this beautiful liquidity, sell side liquidity down here before moving up for the day. And I think that was 157 points I took on that day. This is what I'm looking for, and I'm looking for these types of moves 2 or 3 times a week, ideally 3 times a week. So we've got previous week high up here. We've got previous day high up here. We've got this hourly SIBI that price has expanded up, used it as support, and then continued to move up. And this SIBI as well is a daily. This is our daily SIBI up here. This is one of our key areas. Let's just go back to the 4 hour, and I'm just gonna bring this into view a little bit here for you. There we go. So I'd like to see some sort of a pullback, either down into this daily, even maybe down into this hourly, before expanding up later in the week, and potentially using Tuesday as the impetus for price finding enough strength and liquidity to move up. So that's where I am. I just also want to show you that wicks up here into this blue box up here and to this blue level up here. The last time we were up here was December the 10th. And so if price can get above this BISI, that's what I'm looking for next. Then, you know, use this CIBI up here to get above it. If we can get above that, then reach for all-time highs. So there's a number of levels here that are key. We need to be on our game. We need to be watching. And ultimately, if price is going to move higher, it needs to move lower first. So there we go. Let's quickly move now to a ForexFactory. We can take a look at what to expect, what days we can anticipate potentially some good price action. So Monday's a no trade day for me. It is the day before CPI, which I don't trade, but I will be tape reading on Tuesday, January 13th. Sorry, I'll be tape reading on Monday, but looking for a trade on Tuesday. Wednesday, we have core PPI and retail sales. This is another day where we're going to have some movement in the market for potentially a good trade day. So that's Wednesday. Then Thursday, we have unemployment claims. Again, nice volatility that will come into the market at 8:30. So this is another potential good trade day. And then Friday is a no news day. So Friday will be 9:30 a.m. volatility coming into the market. So that's what we've got on the calendar. Now what I want to do is I'm going to share with you guys 6 pro tips. These are pro tips that are in relation to the Power of 3 model that I use. And let me just see before here we go. This is, I mean, you guys know this is kind of what the model looks like here, right? So we have accumulation, manipulation, and then distribution. The distribution is the area that we want to capture in any of our trades. So we are looking for and trying to identify manipulation. If we can identify manipulation, then we're able to go down into a smaller time frame, look for a smart money reversal or entry, and then ride the distribution here. So that's ultimately what the model looks like. So I've got 6 pro tips that I want to share with you today on tips that are in support of the Power of 3 model. So pro tip number 1, if manipulation occurs before the macro window, so the macro window is 00:45 to 00:15. Okay, so it's a quarter to the hour to a quarter past the hour. So if manipulation occurs before the macro, the trader can anticipate a continuation once the macro begins. An example of this was on Friday when I believe the manipulation was somewhere around 9:32, 9:35, somewhere around there. And then we saw the distribution happen around 10:08. So when we have manipulation, clear manipulation happen before 9:30, then we can anticipate a continuation once that macro opens up. Pro tip number 2, if manipulation occurs before the macro, the trader may consider entering the trade 3 minutes prior to the macro starting. So for example, if manipulation happens at 9:32 a.m., the trader may enter the trade at 9:42 a.m., anticipating the move to begin at 9:45. This 3-minute early entry is to avoid missing the trade. You know, sometimes the macro begins and then, you know, price just takes off really, really quickly. So this is a rule that you could look at adding to your particular trademark entry model, and just consider this adding that to your model. Pro tip number 3, I like to use the 4-hour candle open as confluence. So the 4-hour candles open at 6 a.m., 10 a.m., and 2 p.m. The wick of the candle is the beginning of the formation, and it can be manipulation. Once the wick forms, the trader can anticipate the trade moving in the opposite direction. The body of the candle then is the distribution phase of the Power of 3 setup. So if we look at Friday, what happened Friday, is we can see here is the 10 a.m. candle, this big green candle here. Price opened here. Price moved down. It swept out everything down here. So you can see the bottom of this candle, right, is the bottom of our 4-hour candle. It swept out Asia low, London low, and all of this liquidity down here, and then proceeded to move up. We want to be entering on the wick of the 4-hour candle. Consider that to be the manipulation. So when you see the candle open and immediately move down or expand downward, then in our minds we can say, okay, this is likely the manipulation. So where is price going to move down to take the liquidity before moving higher? And that's exactly what happened. And the body of this candle here, in essence, is the distribution phase, right? So we have accumulation, manipulation, distribution. This green body here was the distribution. It was beautiful. I think it moved close to 300 points. And then the 2 o'clock candle opened up here. So it was open, low, high, and close. Okay, pro tip number 4. The basis of this model is ICT's unicorn model. ICT says this model is its highest probability trading model. A breaker combined with an inverted fair value gap plus a fair value gap is high probability. Combining this strategy with time coming first inside a macro, provides the potential for a very high probability trade. Pro tip number 5, only move down to the lower time frame when you can identify trend on the 1 hour. So what does that really mean? You should be able to, with confidence, determine whether trend is bearish or bullish on the 1 hour time frame. Now, if that is difficult to do, or you're not able to determine the trend on the 1 hour, then do not move down to a lower time frame until the market gives you more information about whether it wants to be bearish or bullish. So if there's confusion on the 1 hour, it's usually because price is accumulating, something like that. So when it's very clear on the hourly time frame, the trend, then you can feel free to move down into the lower time frames to look for an entry once price moves into an area, a 1 hour or 15-minute fair value gap or breaker block. And pro tip number 6, the highest probability change in the state of delivery will occur when 2 correlated or inversely correlated markets produce a change in the state of delivery. So in other words, when we are watching ES and NQ, when both of them have a change in the state of delivery in the same direction, then the probability of that trade working out it's a higher probability trade. And that happened again on Friday. If you want to go back to Friday at, I believe it was 10:05, 10:08 on the 1 minute candle, you'll be able to see the change in the state of delivery on both ES and NQ. So ideally we want to see that ES and NQ and NYM are moving in the same direction, but when they both have a change in the state of delivery, we can anticipate a trade that has a nice probability to it. So those are the pro tips. I have included these pro tips in the description of my videos in every single one. So you can either take a screenshot of this or you can just access them in the description. Next and last for today, I will be creating more of these for you guys. And I will be adding this to our Power3 model. One of the things is when we're looking at a static model on paper or a whiteboard, or, when I'm explaining it in a PowerPoint presentation here, it's very, very easy to see the setup, right? Here we have our point of interest. We have a very nice breaker. We have a high, low, higher, high, lower, low. We have a fair value gap. We have an inverted fair value gap. And we have a change in the state of delivery. I think that we can all look at this and agree that this is the entry model, right? This has all the confluences that we need, that we are looking for, and these are the rules that we have in order to enter the trade. But once price opens in the market, price becomes dynamic, and price is much harder to read when it's running, right? And so then this beautiful paper model, well, we have to take the essence of that and we have to apply it to then a model that's actually moving in real time. And this is where the practice and time on the charts really comes into effect. So I am going to be creating what I call Power of Three. So this is our model, entry nuances. And nuances mean that there are subtleties that happen that are not perfect. They don't look perfect as they do on paper, but these are subtleties that happen that will help you define what your model is and for you to create rules around your model. So I want to talk about entry nuance number one today. And entry nuance number one has all of the confluences that we are looking for. Price hit a point of interest, it has purged or swept liquidity. Um, we get very fast displacement away, and we have a fair value gap that forms, and then we have a second fair value gap that forms. We also have an inverted fair value gap, we have a breaker block, and I'm just going to say for the purposes of this discussion, we have an SMT as well. So everything is lining up. You look at this and you go, awesome. This is an entry, and now I just need to decide, where am I going to get into the trade? Where does my stop loss go? And I need to make sure that my RR risk management is going to be what I need for a trade, right? So one of the questions that may come up is, okay, so if I have my change in the state of delivery right here, and we know that that is change in the state of delivery because we have three down closed black candles that were responsible for pushing the last push of price up into the point of interest. So in this particular case, we have three black down closed candles. That at the bottom is our change in the state of delivery. And we have our beautiful inverted fair value gap. And we have this candle that comes up. So price is moving down with displacement, with force, with vigor. And then this green candle comes in and wicks, and we go, great, that's our entry. But here's the question. Here's the conundrum. Where would we put our stop loss if we were to get in here? If we used our ICT rules and we see that this is the swing high up here, we might think to ourselves, okay, I'm gonna put my stop loss up here, which is, where IC tells us to put our stop loss. So our risk is between here, where we put our stop loss, and our entry, which is here. That is quite a large stop loss. I can tell you that it is too large a stop loss for my purposes. And so we'd have to think, what risk to reward would we need for this trade to make sense? What position size? Uh, you know, Maybe if you trade with 3 or 4 contracts, you might not be able to, the risk would be too high, right? So this is our risk. And some of you may say, well, Louisa, how do I know that price isn't going to come back into this fair value gap? Like, why don't I enter in this fair value gap? Then I get a better risk to reward, right? Risk to reward may be then here, from stop loss here to the midpoint of this fair value gap. But the reality is that when price is moving really, really quickly with very large down close candles, that tells us that price is in a hurry to get somewhere. And so price is not likely to come back here. This second down close candle here, this is a breakaway candle. Okay, so breakaway candle means it's dropping really fast. IPTA has somewhere to get to, and it's going really fast. So we can feel not 100% because nothing's 100%, but we can feel pretty good about entering the trade here and not be worried about price coming back into this fair value gap because it's a breakaway gap. Now, price will come back to this area at some point, but it's just not going to come back from here. So once the change in the state of delivery happens and we get this inverted fair value gap, by understanding what a breakaway gap is, we can have our stop loss, we can move our stop loss into an area that improves our risk to rewards. We may take our stop loss and we may put it either just above this fair value gap or give yourself a little bit of extra room, maybe at the top of this black candle here. We could consider that. If price is moving, when price moves really quickly, price shouldn't come past the consequent encroachment of this inverted fair value gap, okay? And so, and sometimes, like on something like this, uh, it may just kiss the very bottom of this inverted fair value gap and then just explode down, especially when we're inside a macro, right? So I wanted to share this with you. You can take a screenshot of this, but this is Power3 Entry Nuance number 1, and I will be building a PowerPoint with all of the entry nuances that I see that can happen that you as a trader or potential trader can decide what kind of entry model will fit your model, okay? And if you're new to this, I would suggest you just choose one nuance entry and you just stick to that until you become really, really good at that. And then in time, you can add other nuance entries to your protocol. But for now, don't try and trade everything. Just choose, one entry, one type of entry, and stick with that. So I hope this has been helpful. I think I totally messed up the video this afternoon, so I had to come back in and redo this one. So I apologize, guys, because it's always so much nicer when you're on the video, the live with me. But anyway, I messed up. Sorry about that. And I will see you guys tomorrow morning at 9:15 for tape reading because the day before CPI, I don't trade. Okay, everyone, have an awesome night, and I will see you next time. Okay, bye for now.